Hey everybody, I'm going to run through today how to set up a chart of accounts for your business. And typically I find a lot of issues with this, especially when you don't have a financial background. Typically business owners get started and they ask their accountants how to set up their chart of accounts, which isn't a bad thing necessarily, but accountants are going to be creating a chart of accounts in the mindset of doing your year-end taxes, which is great. I'll try to make you more money, but accountants will keep you out of jail and out of trouble with the IRS. For me, as a fractional CFO, what I like to do is set up the chart of accounts. In particular, today I'm going to go over the P&L in a way that you can make better business decisions. So we certainly are still going to have accounts in there for tax benefits, but specifically, I want to make sure that we have things set up so that you can analyze your margins throughout, not just overall, but be able to do that on a per product line and do the month over month and see those trend changes so that you can make better business decisions. So jumping right into it, we are going to play with a company here. I'm going to do a very simple chart of accounts. There's definitely other categories that you could make with this, but I'm going to do it very simple. We're just going to run through a coffee shop. For your income account for a coffee shop, as you'd expect, one thing would be coffee sales, right? That would probably be your main source if that's what you do. You might also sell a couple extra things. So you might sell baked goods that go with the coffee as well as merchandise with your branding. So what I like to do is set up our cost of goods sold, which I can explain in depth in another video, but your cost of goods sold will be your direct costs that go into fulfilling your sales, right? So I always tie those to a sales account. So to that end, we would have coffee beans as a cost of goods sold, right? Because that is a direct cost that goes into making your coffee sales. Then at the same time, I would do baked good materials. That would go into making your baked goods and then purchasing the merchandise to then go and sell. So right there, you can see everything is tied up. What we can easily do on any given month is show month over month trends, but also your margin. If we sold $10,000 in coffee sales and it costs us $5,000 in coffee beans, we have a 50% gross margin on that particular line. Now we're going to sum up income and cost of goods sold, get your gross profit overall, and you'll have your total gross margins for your company. But it's nice to see each individual line, because if you don't do that, you can often think, well, I have 50, 60% margins, but you don't know necessarily that coffee sales might be 95% gross margins and your baked goods are killing you, or your merchandise sales are bad. Those might be dragging your margins down. So we might want to shift our focus, or we might want to fix and say, well, our merchandise costing is too expensive, right? We need to get that down so that we can create a larger margin there. This allows you to see those insights and make those decisions. Same thing down here, expenses. You still want to pull out all these different things. These are some common expense accounts. There's obviously a lot more you can get into, but what you want to do is find your key areas. Obviously in expenses, you're going to want to find those accounts that will give you tax benefits at the end of the year. But then what you want to do is, on the expense side, it's all about operating efficiently from a business perspective. You want to have as low an overhead as possible. The lower your expenses, the more net profit that you get at the end of the year. That's just being a good operator of a business. So we want to get the most out of it, be able to run the largest gross margin, that income to COGS difference, with the least amount of overhead possible. So we want to have category buckets here so that we can analyze what is going right and wrong here, right? We could just say everything else is expense and have no analysis of that, and you wouldn't know what fluctuates each month. But you can, if you break it down, whatever is your key focus. So payroll is obviously a big piece for most companies, definitely most service-based companies. For a coffee shop like this, that would still be pretty significant. Your rents and utilities would be significant. If you don't have proper categories in your expenses, in expense accounts, you won't be able to analyze what changes, what's too high. You can't even look at industry averages for those and compare with other companies. So you really need to be particular as to what you add as a category. Now, obviously, on the other side of the spectrum, you can get way too detailed and have 50 accounts in your expenses for a simple business like this, and it will cost you a lot more time and effort into maintaining your books. So it's about finding the balance between what accounts you need to make solid business decisions without bogging down, whether that's you doing the bookkeeping or having to pay somebody extra hours to do all the different nitty-gritty expense accounts that you don't really need. If you're not analyzing this on a monthly basis, then try to consolidate it. It's either you're analyzing it on a monthly basis or there is some tax benefit to that account. Anything else you can sort of combine up and sort of bucket into as few expense categories as possible. So I hope that was helpful. If you have any questions or thoughts, leave them in the comments below. Like and subscribe, and I'll see you in the next one.